Well, thank you, Warren, and welcome everyone to the 2016 Teck Annual General Meeting. As I begin my presentation, I wanted to highlight the theme of our annual report this year, essentials. And 2015 was certainly one of the most challenging years the mining industry has seen, and extended right through into a really low point in the middle of January. The first week of January, in fact, was the worst week in equity markets in over 120 years. And coming through this difficult period and emerging stronger requires us to focus on being the best at the most essential aspects of our work. Safety, sustainability, of course, but productivity and financial strength are key. In 2015, our company and our people redoubled our emphasis on these four pillars, and by doing so, we strengthened our competitiveness, achieved excellent operating results, and put Teck in a strong position for success in the years ahead. Now, before I start, I would like to recognize the two directors who are retiring and just say a couple of words. But Takashi Kuriyama and Felix Chi, you've made a tremendous contribution over a combined 16 years on the board, and I want to thank you for your service to Teck and to its shareholders. I'd also like to welcome our two incoming directors, Fukuda-san and Mr. Chong. Welcome to Teck. We look forward to having the benefit of your experience and your guidance as we move ahead. Welcome. And before I go any further, as is required by securities regulations, I need to draw your attention to the important note concerning our use of forward-looking statements and information in this presentation. Forward-looking statements involve risks and uncertainties and are based on numerous assumptions. Many factors may cause actual results to vary. Certain of these risks and other factors are described in our public filings with the Canadian securities regulators and with the SEC, and we do not assume the obligation to revise or update any forward-looking statements except as required by law. Okay, now I want to start by discussing the changes that have been implemented in our senior management structure. We have a number of retirements, a number of members of our senior team who are retiring or moving into phased retirement, which is a practice that we've had for quite a few years now. I think 6 or 7 of the predecessors on the senior management team have gone through phased approach, which we really appreciate because it gives that much more guidance and mentorship in the transition, and it's really worked well. But I want to take this opportunity to thank those individuals for their years of service and many contributions to the company. Ian Kilgour, Executive Vice President, Chief Operating Officer. Ian has literally helped change our culture and instituted operating discipline that will endure for a long time. Rob Scott, our Senior Vice President, Zinc. Over his 35 years with Teck, Rob has led almost every business unit and really has embodied and helped define our core values over the years. Ray Repus, our Senior Vice President, Energy. Ray laid the foundation for the development of our energy business, and that will generate value for Teck for many years to come. And Ray will stay on half-time as we carry on in the permitting process for Frontier. And Tim Watson, Senior Vice President, Project Development. Tim will also remain half-time with us with a complete focus on Fort Hills, which is, of course, is our most important project, and it will get us through to completion. So we'll be fortunate to continue to have the benefit of the experience of those two individuals over the coming year or so. So please join me in wishing all of those executives well in the future. And with those retirements occurring in 2016, we're also taking the opportunity to streamline the business unit leadership and to further align our management structure with the current business environment. We are combining the zinc and copper business units under Dale Andrus, who will be Senior Vice President, Base Metals. The coal business unit will be under Robin Sharametta, Senior Vice President, Coal. And the project business unit will move to be under Alex Christopher, so his new role will be Senior Vice President of Exploration, Projects, and Technical Services. Now, this new structure will further contribute to the overall performance of our business. It reduces the levels of senior management, making the connection between the sites and myself that much closer. And it also aligns all stages of project development, from grassroots exploration to project development to construction, all under the same leadership. It frees up Dale and Robin as heads of base metals and coal, respectively, to focus entirely on the operations and delivering the tons at the lowest possible costs. And it aligns all of our logistics functions under Andrew Stonkus and our marketing group, so it creates a direct line from the customer through the terminal and the rail shipping right back to our operations. And that will include sales and marketing of our shale of oil production from Fort Hills as we move closer to completion. So this realignment builds on the work we've done to make Teck leaner, more efficient, and more competitive, work that will continue in 2016. We call it One Teck. Safety is the most important part of everything we do, and our goal is to ensure that everyone goes home safe and healthy every day. In 2015, we continued to make progress with a 25% reduction in the frequency of high-potential incidents, which are those incidents that have the greatest risk to seriously harm someone. And those results tell us that our high-potential risk control strategy that we rolled out at every operation over the past 2 years is working. Most importantly, we had 0 fatalities across our operations and projects and exploration sites in 2015. But despite this success in reducing our most serious incidents, our total reportable injury frequency did edge upwards, which reinforces that we cannot waver in our work to build a culture of safety across Teck and to continually improve our safety performance. Turning now to our financial results, 2015 was a year marked by continued oversupply and record low prices for a number of our key commodities, which impacted revenues. Our revenues were $8.3 billion, with gross profit before depreciation and amortization of $2.6 billion. We recorded impairment charges totaling $2.7 billion on an after-tax basis, which reflects lower market expectations for commodity prices. And after removing the impairment charges and the other unusual items, adjusted profit attributable to shareholders was $188 million, or 33 cents per share. Thanks to the significant cost reduction efforts undertaken, all of our major operations were cash flow positive through the year. We also took steps to strengthen our balance sheet. We completed 2 precious metal streaming transactions related to our Antamina and Carmen de Andacollo operations, which together provided approximately $1 billion of cash. And we extended our main US $3 billion credit facility to 2020. We also put in place a 2-year, $1.2 billion US facility in anticipation of the need for letters of credit related to our pipeline commitments in Alberta and our power purchase commitments in Chile. And we continue to consider alternatives to further improve liquidity. We did repay a $300 million US note in October, and there are no notes due until early 2017. And as a result, we ended the year in a solid financial position with over $6 billion of liquidity, including a cash balance of $1.9 billion and that US $3 billion credit facility untouched. Looking across the mining industry, I can say there aren't that many of our competitors who came into 2016 in as good a position as we did. It's been a very tough year for most of the industry. And unlike many of our peers, we are not in a position where we need to issue equity or to sell off our core producing assets. From an operating standpoint, we had a very strong performance across our operations and business units in 2015. As outlined in this slide, we achieved or exceeded our production guidance for each of our major commodities, and we also achieved record annual production of zinc and silver at our trail operations and record mill throughput at Antamina. Cost reduction, of course, remained a major focus across our operations in 2015. Cash costs per unit of production were reduced at all of our operations. In fact, since 2012, we've reduced total site costs at our steelmaking coal operations by 24%. Total cash costs at our copper operations are 16% lower before byproduct credits. And cash costs for zinc are also down approximately 7%. So on an annualized basis, we have cut operating costs by a total of $820 million from when we first initiated the first round of cost reduction program in 2012. And this is a major achievement and a direct result of hard work and dedication of employees all across Teck. Our major development project, the Fort Hills Oil Sands project, it remains solidly on track. Construction is over half completed, past the 55% mark, and it remains substantially on budget. Our share of the remaining budgeted capital expenditures is just $1 billion now as of the end of the first quarter, and importantly, it is fully funded under our current cash balance. Obviously, oil prices remain the subject of much discussion. However, it is important to keep in mind that we are close to 2 years away from first oil, which means there is significant time for current low oil prices to impact production, and we are seeing that happen, and I believe that the trend line is going our way. And the current consensus is that long-term oil prices will be higher than current prices, and also remember, Fort Hills is a 50-year project that will operate through multiple price cycles. So overall, the current oil price weakness continues to actually be a benefit for us because it increases cash flow at our current operation while making it easier to keep construction at Fort Hills on track. And we look forward to completion in the second half of 2017 and the additional cash flow we expect Fort Hills to generate upon reaching commercial production sometime in the first half of 2018. In sustainability, we've marked 5 years since the development of our sustainability strategy and the completion target date for our first set of short-term goals. And I'm proud to say that thanks to the hard work of our employees, we achieved all 28 of our short-term goals, and in some cases, we exceeded them. Achieving these goals, which were not easy, it's led to improvements in performance and efficiency at our sites, including reductions in energy use and reductions in greenhouse gas emissions, strengthened water and biodiversity management, and improved safety performance. The steps we took to achieve those goals are also creating savings. For example, projects to improve haul truck efficiency have reduced greenhouse gas emissions, cut diesel use by 10 million litres per year, and are saving Teck about $10 million a year annually. We are releasing our 2015 Sustainability Report this week. It will be available at teck.com, and I encourage you to have a look and see more details on our progress. I also encourage you to look to the cover photo and compare it to the cover photo of our annual report, because we deliberately chose them. It's a little bit of a generational thing, and I hope you notice. Our sustainability performance was also recognized by several prominent ranking institutions over the past year. Teck was again named to the Dow Jones Sustainability World Index for the 6th consecutive year, and that's the top level of that index. We were also named to the Global 100 Most Sustainable Corporations list by Corporate Knights for the 4th consecutive year, and the FTSE for Good Global Index for the first time this year, so we're proud of that. Turning to the market outlook for our core commodities, prices remain low. While we've seen a move and we have a bit of a tailwind in coal and zinc, they are still on an absolute level quite low compared to the last 8 to 10 years. But we have seen a change in direction, and that's important. After 5 years of declining prices, it appears that the bottoming out process is done and that prices may be beginning to rebound. In zinc, and I've been talking for a while about the closures of a number of large mines and how that would impact global supply, and those closures have now happened, and that concentrate has now been sold. It doesn't exist anymore. We're starting to see the effects of that now in the market, with shrinking inventories and a growing zinc deficit and rising prices. At the same time, demand is strong. Imports of refined zinc to China were up about 200% in the first 3 months of 2016, admittedly off a low base, but definitely the right direction. So we are positive on the outlook for zinc, particularly as we move into the second half of 2016. And meanwhile, copper remains in slight oversupply, and it's our expectation that that will remain the case for the near term. However, we believe the oversupply is not that significant, and an increase in demand or a disruption in supply, and we see that from time to time, could push the market into balance or even deficit, though we don't anticipate that occurring this year. You never know, it could be possible. In steelmaking coal, although we started the year still in oversupply, better demand has shown up recently, and the potential significant supply issues in China have changed the outlook for the market very recently. In fact, just in time, last night, the coal price actually cracked the $100 ton mark. Globally, over 65 million tons of production cuts have been announced to date, and we expect to see additional supply come off to move the market into balance if it's not in balance already. U.S. exports in particular have declined, but are still about 50% higher than historical averages, so we will need to see some more production come off here, and I think we'll see that in the coming months. And with the market closer to balance, that tension is starting to exert upward pressure on coal prices. And one of the good news earlier this month was we saw the quarterly benchmark price for Q2 actually increase by $3, and that's the first increase in the benchmark price in 9 quarters. And the spot prices have moved, as I said, just slightly over $100 in the last 24 to 48 hours. So looking ahead, we know China will continue to be the biggest demand driver for all of our commodities. And just related to that, you will have received a summary card of China's 13th five-year plan on your chair. I did this 5 years ago with the 12th five-year plan. And my main point about that, I was sharing that card with you because it's a good indicator of where demand is headed. If China puts something in their 5-year plan, it is a commitment, and you can count on it. You can bet on it. And if you read what's in there, there's some very big plans that will require serious supplies of commodities. So some of the key points: China is planning GDP growth of at least 6.5% per year. And to put that in perspective, that's the same as adding the equivalent of the whole country of Turkey's economy each year. Urbanization will continue to increase. Major infrastructure spending will continue on rail and housing and power facilities. And the plan also calls for a reduction in coal capacity by 500 million tons, some portion of which will be steelmaking coal. All of this suggests continued strong demand for the commodities we produce, because there's one thing we know, as I've said earlier, that when China commits to do something in their 5-year plan, they get it done. Our focus throughout 2016, building on our work over the course of 2015, is threefold. First, we've set a target for all of our mines to be cash flow positive. Second, we will continue to fund our remaining capital commitment for Fort Hills from our internal cash. And third, we will maintain the strength of our financial position. Our 2016 target is not to draw on our US $3 billion credit line at all, and to finish the year with a cash balance of more than $500 million, and we are certainly on track to do that. In support of that, we will continue to evaluate additional options to strengthen liquidity throughout the year. And as difficult as this period is, the steps we are taking today to strengthen our balance sheet and reduce costs and improve the efficiency of our business will ensure that we come through this downturn in a strong position. In fact, I believe we will emerge as one of the best positioned companies in the sector. That's because, unlike many of our peers, we intend to come through this downturn without issuing equity or diluting our shareholders. Meanwhile, you can look at a long list of our major competitors who have already issued billions of dollars in equity and have diluted their shareholders. Nor will we sell any of our core producing assets. And you will note that many of our competitors are selling operating asset, mine after mine are being for sale. So that will mean when you add in the fact that we are going to increase the amount of production behind every share through completion of the Fort Hills project, that there will be more production per share for each Teck share, while our competitors will have significantly less production per share at the end of the downturn. And so we will leverage the benefits of our diversification strategy. Our exposure to zinc and steelmaking coal will look to be the near-term best performing commodities. And we will do this all at the same time as continuing to reduce our overall debt. So when the next phase of the cycle comes, Teck will be ready with the right combination of balance sheet strength, production, and commodities to capitalize on it, and to generate significant value for our shareholders, our employees, and our communities. So thank you very much, and with that, I will turn the meeting back to Warren for questions.